Hello and welcome to the UUA Office of Church Staff Finances webinar on imputed income. My name is Sean Griffin and I am the Compensation and Benefits Specialist. In this webinar, we are going to examine reporting imputed income, long-term disability, life insurance, and taxes. Here in the Office of Church Staff Finances, our mission is guided by the values of our faith. We equip congregations for excellence as employers and their staff for financial competence and well-being. This session, I'm going to be talking about imputed income and reporting that income on an employee's W-2. Now, because there are two UUA recommended benefits that result in imputed income, that's UUA long-term disability insurance, just referred to as LTD, and UUA group term life insurance, just referred to as a life, we're going to review the specifics of reporting imputed income specifically from those two benefits. What is imputed income? The IRS considers all compensation taxable, and compensation is anything of value given in exchange for labor. That can be either cash or non-cash. Cash is wages, bonuses, etc., and non-cash is referred to as fringe benefits. So one example that's beyond the scope of our review today of a taxable fringe benefit is when a congregation pays moving expenses directly to third parties on behalf of an employee. It's very important to note that fringe benefits can result in imputed income. And while we're going to specifically focus on UUA offered LTD and life insurance benefits, you can get more information on all taxable fringe benefits by reviewing IRS publication 15B. There's two other things of note. LTD reporting is optional, but if it's not reported, it can have a substantial tax impact on an employee at the time of the claim. And it's important to note that life insurance reporting is required by the IRS. Now let's dig into both of these, starting with LTD. Let's look at LTD first because it's the easiest and it will have the biggest impact on employees if the benefit is needed. Now, it's worth noting that this advice applies if the congregation pays the LTD premium as the UUA recommends. If the employee pays for LTD benefits with after-tax earnings, there's no need to report anything. But if the congregation is paying or if the premium is paid by the employee pre-tax, you should report it on the employee's W-2. Now, as noted just a moment ago, as a legal compliance issue, reporting LTD premiums is optional. But as an expression of care for our staff, we strongly recommend reporting premium payments. Now, we advise this because reporting, if the LTD premium payment is not reported, if it's not taxed, then any benefit payments will be later subject to taxes. For employees who suffer a disability and need the support of LTD insurance, this means their insurance payments will be reduced at precisely the moment that they most need the support. Now, luckily, reporting LTD premiums is very easy. The employer simply records the actual premium amount paid for the year, includes that on the employee's W-2 in boxes 1, 3, and 5. Those are all the gross income boxes for total wages, wages subject to Social Security taxes, and wages subject to Medicare taxes, respectively. You can optionally also list the LTD premiums paid in box 14 with an explanatory note. Box 14 is just for the convenience of the employee and the employer, so it's not required by the IRS to list it there. W-2, an example W-2 looks like. Boxes 1, 3, and 5 are circled in red. That's where you would report the actual LTD premium paid. And then in box 14, that's circled in kind of that blue-gray color, and that's the optional listing. And that's it. That's all you have to do to report LTD premiums. So it's just a very small bit of administrative work from the congregation and a small additional tax burden for the employee. But then those congregational employees are protected from a hefty tax bill if LTD insurance is ever needed. Now, unfortunately, life insurance is a bit more complicated. Unlike LTD premiums, which are optional to report, the IRS requires that the amount of life insurance over $50,000 must be reported as taxable income. This is a legal compliance directive. Also, unlike LTD premiums, you don't report actual payments. You have to go through a bit of math. So in addition to this webinar, we have a page on the UUA website, Premiums and Important Tax Information for Life and AD&D Insurance. The address is on the slide, and we'll also include it again at the end of the presentation. Keep in mind that UUA life insurance, the maximum benefit is 2 times the employee wages up to $200,000 in benefits. And as noted a moment ago, the first $50,000 of life insurance benefit is tax exempt. Now, there are adjustments to benefits for employees after they turn 65 and again after they turn 70. So if you have employees in those age categories, please do check out our webpage or reach out for some additional help. Now, before you can determine an employee's imputed income, before we get to that math, we're going to need to collect a little information. For each employee, you need to know their actual annual earnings for the year. And for a minister that gets a housing allowance, that is both salary and housing. You're going to need to know the age of the employee in that year. So, for example, if an employee turned 35 in December, anywhere in the year, they're considered 35 for that year. And the last thing you need to know is the number of months the employee was covered in the calendar year. So how long were they actually enrolled? How many months in the group term life insurance offering? So, and the other thing just to note is that if the employee pays any part of the premium post-tax, their tax liability will be reduced. Now, since the UUA recommendation is for the congregation to pay the life insurance premium, we're going to approach it from that perspective. If you have a situation where the employee is sharing the cost or paying the cost, you may just want to check with your accountant or reach out to us for a little bit more guidance on that little bit more complicated situation. Let's take a look at the formula that the IRS gives us for calculating imputed income for life insurance. And this is what it is. Don't worry, it's a bit long, but we're gonna break it down and work through it. So it's the amount of life insurance minus that $50,000 that is exempt. You divide that by 1,000. You then multiply that by the employee's age index. Don't worry, we'll get to that in a second. And finally multiply that by the number of months the employee was covered in the calendar year. So let's look at the first part, the amount of life insurance. And that is equal to the employee's annual earnings times 2 up to a maximum of $200,000, because that's the maximum benefit under the UUA life insurance plan. So 2 times their annual earnings up to a maximum of $200,000. The second part, the employee's age index, is taken from IRS publication 15B, which we talked about earlier, table 2-2. Now we've got that table reprinted on our webpage, and I've also put it here for you. It's pretty straightforward. You just take a look on the left-hand side, match the employee's age under that column, go over to the right-hand column, and that gives you under cost what is their age index, or their cost index that you're going to plug in into that second part of the formula. And the third part is really straightforward. It's just the number of months that the employee was covered in the calendar year. So let's examine this formula. I think it's helpful to do with a couple of case studies. Oh, here is our first example, our first case study. And this is imaginary employee Bud. And Bud made annual earnings last year of $24,200. Is 33 years old in the previous year, and enrolled in the life insurance, started being covered in February. And 100% of their premiums are paid by the congregation. So we have that formula we talked about. We need to figure out the amount of the life insurance, their age index, and the number of months covered in the calendar year. And so the amount of life insurance is their annual earnings times 2 up to a maximum of $200,000. And then it's going to be minus 50,000 and divided by 1,000. So we do that first part of the math. And you can see I've already plugged in the age index. It's actually just because I meant to bring up the chart first before I did that. But we see that Bud being 33 years old, looking on the left, he's between 30 through 34. And that gives us a cost or an age index of 0.08. So that's where we got that number from. And 11 is because they started being covered in February, which meant they had 11 months of the year of coverage under the life insurance program. At this point, it's just plugging numbers into your calculator or Excel spreadsheet, or counting on your fingers if that works for you. So as we start to do the math, what you see in the third step is that Bud's total, 2 times Bud's total annual earnings are actually less than $50,000. So you ended up with a negative there, right, of minus 3,200 in the third step as we work through this formula. What that means is that Bud actually did not exceed the tax-exempt amount for their life insurance. Therefore, they have no burden of imputed income. So a good rule of thumb to remember is if an employee made $25,000 in annual earnings or less, you actually won't have anything to report because they won't exceed the amount that's exempt of that first $50,000. So I hope that makes sense. Let's move on to a second example, which will help continue to enlighten how we generate the imputed income for life insurance. In this second example, we have imaginary employee Micah, who made $104,700, was 38 years old, not employed, but covered under the life insurance all year round, and had their premiums paid 100% by the congregation. So again, we have our formula where we need to determine the amount of life insurance, their age index, and the number of months covered in the calendar year. And again, the amount of life insurance is their annual earnings times 2, up to a maximum of $200,000. That's actually going to matter in this particular case. And we've got our table here again. A 38-year-old individual falls between 35 and 39, so that gives them a cost index of 0.09. All right, let's take a look. So we've plugged in our numbers, plugged in our amount of life insurance is going to be times 2, so that's going to be the 104,700 times 2. We've also put in our age index and 12 months for someone who was covered under the life insurance program all year round. Now we just need to do our math. So we double their annual earnings, you get 209,400. Now that's important to remember that the maximum amount of life insurance is $200,000. So we just add an extra step here and just adjust their amount of life insurance to that cap of $200,000. Now you do the rest of the math, and voila, this is what our calculator tells us is Micah has an imputed income of $162 that we'll need to include on their W-2. And don't worry, we're going to talk about exactly where it goes in the W-2 in a few moments. Take a quick look at with you. And in this example, we have employee Iris, and they earned an annual income of $44,600, are 47 years old. Their coverage started in November, and again, it's 100% paid by the congregation. So we have our formula here again, which we've covered several times. And the reminder about the amount of life insurance is their annual earnings times 2 to a maximum of $200,000. We have our age table where we can see a 47-year-old individual has a cost index or an employee age index of 0.15. We put those into our formula along with only 2 months of coverage for November and December for this employee. And then we do our math. And in this case, we see that this individual has a imputed income of $11.76. Reporting imputed income on an employee's W-2, just like LTD, is also done in boxes 1, 3, and 5. There's one additional step. You must additionally report the imputed income for life insurance in box 12. I circled 12A, but you can use you just continue to use those if you have more than one entry. For most congregations, you're only going to have the one entry in 12A. The important thing to note about when you put the imputed income for life insurance online or in box 12, you have to put a code there as well, and you need to use code C as in Charlie. So code C for life insurance imputed income is what goes in box 12. And that is the end of our review of imputed income, LTD, and life insurance and taxes. Thank you for spending a few minutes with me. In the next slide, I'm going to leave you with a recap of the additional resources that have been covered in this webinar. And of course, we recommend checking in with your accountant or payroll company. In the resource list, you'll also find the email address for the compensation team. So please feel free to reach out if we can be of assistance. Thank you and have a wonderful day.